So how do you value your stock to make sure that you're not overpaying for the shares in which you're investing into? Outside the world of investing, nobody wants to overpay for anything. You wouldn't go down to a car dealership and be happy to pay 10, 20 or 30% more than the market value of the vehicle. So why would you do the same for the stocks in which you're investing into? But what defines the intrinsic value of a stock, and how exactly can we calculate it? Well, there are multiple different theories out there, and it's a little bit of a mixture of a bit of science and mathematics and a little bit of estimated guesswork as well. But what we will be able to do is use some financial metrics in which we have available in order to kind of create a pretty accurate assumption on what intrinsic value actually is. In today's video, I'm going to take you guys through a live example in order for us to actually calculate the intrinsic value of a stock. So be sure to follow along and apply the same principles to the stocks in which you guys are investing into in your own investment portfolio. And be sure to let me know down in the comment section, guys, what stocks you guys personally believe are trading at fair value right now. And of course, whilst you're over here, guys, you might as well subscribe to the channel if you like any kind of videos on investing and the stock market. As well, drop a like on the video, guys. It really helps out the channel. With that being said, let's dive straight into it. So as defined on investopedia.com, intrinsic value is a measure of what an asset is worth, and that asset in this context being the company in which we're investing into. This measure is arrived at by means of an objective calculation or complex financial model rather than using the currently trading market price of that asset. So in simple terms, the current market price of a stock doesn't dictate its value. For example, just because Amazon is currently trading at $3,500 per share doesn't necessarily mean it's worth $3,500 per share. But to double check this, we can do some pretty fancy calculations using some financial metrics in order to overall calculate the intrinsic value of the company in order to define whether the value of the current market price is worth investing into or not. And those financial metrics in which I am referencing are those like an earnings per share figure as well as the price to earnings ratio as well. So the formula in which we're going to look at today in order to calculate intrinsic value is earnings per share times 1 plus R times the price to earnings ratio. Now, before you guys think what the does that mean and click off this video, let me go onto Google Sheets and I'm going to break it down in a little bit more detail. So up on screen now, what you guys can see is a little bit of a template in which I've put together on just some financial metric analysis, and you can see this formula in which I've just explained to you guys, but we're going to break it down step by step. So first things first, we need to get the company's earnings per share. Now to do this, I'm simply going to go on to Yahoo Finance and I'm literally just going to have a look at Amazon. I'm going to go onto the summary tab and you can see that it'll give us an earnings per share or trailing 12 months earnings per share figure of 57.4. So I'm going to come back over to my spreadsheet and type in 57.4. The next thing that we're going to need to calculate is the expected earnings growth rate. Now, in order to get this, well, it kind of comes down to whether you guys personally have some kind of expectation on the growth rates in which you expect for the stock in which you're investing into. But for the purpose of this example, I'm just going to keep it simple and I'm going to rely on Yahoo Finance Analyst instead by going on the analysis tab, and we're going to scroll down right towards the bottom and you can see we've got growth estimates, and I'm going to plug in the next 5 years worth of growth rates, which is 35.77% per year. Then finally, we've got the price to earnings ratio, which if we just click back onto Yahoo Finance and go back onto the summary tab, you can see we've got a price to earnings ratio of 60.14. So if I drop that in there, 60.14, that will then spit out the intrinsic value calculation. And just to give you guys kind of the detail and the formula in the way in which I did this, I simply calculated the earnings per share figure. I then multiplied that by 1 plus the earnings growth rate, and then multiplied that by the price to earnings ratio, which then spits out an intrinsic value of $4,686 per share. But as with value investing, one of the things that we're going to need to speak about is something called a margin of safety. Because as a value investor, you're going to need to build in a little bit of margin for potentially some inaccuracies in some of the calculations in which we've made based on the growth estimates, which might not be 100% truthful. But what exactly is a margin of safety? Well, it's a principle of investing in which an investor only purchases securities when their market price is significantly below their intrinsic value. So in other words, we take the intrinsic value of the stock and then we apply a discount to it. And one of the main reasons why can be summed up pretty well by an individual called Seth Klarman, who actually wrote a book called called the margin of safety. He summarizes it pretty well by saying a margin of safety is achieved when securities are purchased at prices sufficiently below underlying value to allow for human error, bad luck, or extreme volatility in a complex, unpredictable, and rapidly changing world. Now, obviously, depending on how aggressive you want to be with the investment in which you're making will largely depend upon the margin of safety in which you apply to your intrinsic value calculations. Some investors may look for a 10% margin of safety, but other more conservative investors may be looking for 20, 30, 40, or even 50% margin of safety on the intrinsic value in which they've calculated. But for the purpose of this example, I've applied a margin of safety figure of 20%. So simply put, all I've done is when we look at the formula is I have applied the intrinsic value. I've then multiplied this by 1 minus the margin of safety, which has spit out a new value or new intrinsic value of $3,749.46 per share, which based on this calculation, we can assume based on these numbers that we have a difference to the current market price of about 8%. So you could certainly suggest that the price of Amazon stock currently is roughly about 8% undervalued, which assuming we already have a 20% margin of safety and we also have another additional 8% difference between the current market price and our intrinsic value calculation, you could say that investing into Amazon right now would certainly suggest that it's pretty good value. And interestingly enough, when you look at the Yahoo Finance analyst predictions for Amazon stock, they actually have targets of $4,125 per share, which isn't all too dissimilar to the intrinsic value in which we've calculated just now. But there is a little bit more in which we can do with these numbers in order to calculate a slightly more accurate intrinsic value. Because as a predominantly a long-term investor, we're certainly going to want to look to forecast out the future potential projected earnings of the business in which we're investing into. But not only that, but we also want to understand whether the desired annual rate of return in which we're looking for out of that stock can be achieved as well. So in order to do this, we're going to have to do a few more calculations, and I am going to try and do this formula step by step, so hopefully you guys can follow along with me. So first up, we're going to go over onto the right hand side, and in the year 2021, well, we are going to apply an earnings per share figure of $57.40, and then we're going to extrapolate that earnings per share figure out until 2025 on the basis that we're going to achieve a 35.77% annual rate of growth. So in order to do this, I'm going to go equal sum. I'm going to do $57.40. I'm going to multiply that and I'm going to open the bracket. I'm going to put 1 plus 35.77%. And then I'm going to close the bracket off and press enter. But I'm also going to fix in D9 just so it carries on with that formula, and then I'm going to drag it across. And as you guys can see, the forecasted earnings per share figure for Amazon by the year 2025 should be $195.04 per share. The next thing that we need to look at is the price to earnings ratio in 2025. And this is where it becomes a little bit more difficult because, as I'm sure many of you guys know, price to earnings ratios literally change year in, year out, depending on the overall performance of the business and the performance of the price of the stock as well. So because of that, it can be extremely difficult to forecast. And this is where some of the guesswork does start to come into play. And when we look at Amazon's price to earnings ratio over most recent years, you can see how much it's changed from trading at over 300 times earnings in December 2017, right the way up into kind of now where we're trading at just about 60 times earnings. So on that basis, we're kind of going to assume that that price to earnings ratio will continue to drop off slowly over the course of the next 5 years or so ahead. And as a result, I'm just going to write out a slightly new column here, just price to earnings. And I'm just going to apply a price to earnings ratio of 50. Then what I'm going to do is I'm going to go equal sum and I'm going to multiply the 2025 earnings per share figure by the price to earnings ratio, which gives us $9,752.08, which is the forecasted share price that we would expect Amazon to trade at in 2025. Now, of course, obviously, $9,752 in 2025 feels like a pretty good return on investment on the basis that we're only trading at about $3,500 per share today. But does it actually equate to good value when we discount it back, assuming a rate of return in which we want to receive? Well, on the basis that Amazon is forecasted to grow at 35% per year, I've put a minimum return figure in which I would expect from the stock price to be at least 20% per year. So in order to be able to calculate this, what I'm going to do is I'm going to go equal sum. I'm going to take the share price in 2025. I'm going to divide that by 1 plus the minimum return on investment in which we expect to receive. And I'm also just going to lock off those numbers as well by putting the dollar signs in as well. and then I'm going to drag this right the way across, and this will discount to the 2021 intrinsic value of Amazon stock price being $4,702.97 per share. Applying that kind of same general rule of thumb of having a margin of safety of 20%, I've already added the calculation in here, as you guys can see, giving us a new intrinsic value figure of $3,762.38 per share, giving us a difference to the current market price of 8.46%. Which, if I'm honest guys, we've done two kind of different calculations here, but they've pretty much spat out the exact same number, which both assumes that based on a 20% margin of safety, the difference to the current market price is still about 8.5%, so you'd certainly expect the price of Amazon stock right now appears, on the basis of this calculation alone, to be somewhat undervalued. Now, of course, this isn't the only method in order to calculate the intrinsic value of a stock. You can also use other methods like the discounted cash flow model, which if you guys want me to do a video on, be sure to let me know down in the comment section below. And if you enjoyed the video, guys, all I ask is that you drop a like on it, as well as subscribe to the channel if you're new around here. And with that being said, I'll see you over in the next video.